This is our Forex video blog for January 24th, 2011. One of the first things you want to do anytime you start trading is get a feel for which currencies are strong and which ones are weak. Looking at our currency meter, most of us trade the dollar and yen versus the bottom pairs. So today you can see the Australian, without a doubt, was consistently strong all day. However, the weekly and monthly trend is down, so it's a little bit less likely for this to happen. But if a currency goes one way 3, 4, 5 days in a row against multiple different currencies, this is the Australian just by itself. If the Australian was very weak, which it showed the weekly and monthly trend being, in down too much against most currencies, then it's likely to have a counter trend pullback day. It doesn't mean that it's going to go up and stay strong the next day, but if you see consistent strength like this, you can trade it. Be watchful when you're trading against a longer time frame trend, though, of this strength slowing down or any kind of extreme weakness hitting the dotted 80 line up here. This one never really had any significant weakness all day, and therefore the trend continued. The yen, which was definitely weaker than the dollar today, would have been a good pair to trade the Australian against. So you want to buy the strong Australian versus a weak yen. And in a perfect day, you would find strength in real-time strength in a currency, and the weekly and monthly trend would match up with it. At least with the yen, it's slightly weak, weekly and monthly trend. So, you know, the real-time strength versus the real-time weakness. Let's bring up the Australian yen. And you can see, you know, starting last night, Sunday night, it had some strength. It's still on a fib level that could act as support resistance. Once it gets above here, I see some really good trades. You got a good breakout trade right here. The next resistance area is up here at our fib level, and beyond that is the weekly pivot, which is a likely reversal area. On the way up, it didn't have that much statistical strength against the yen. So you might have got into this trade here around 81.90. It went up about 20 pips, kind of ran out of steam. This is apparently Friday's high, and without that much statistical strength, it's likely to stall at the fib level. And then you had to pull back down. This fib level here is likely to be support. It didn't have that much weakness, slightly less weakness than the strength. It's above the hourly, and you get back in again, and you might have got out of half your trade here. Fib levels, once hit the second and third time, they're more likely to go through. So you tighten your stop in the second half, and it goes up to the 10-day moving average right here. Again, it doesn't have that much strength, so you get out of that trade with maybe 35 pip profit. And you might have looked to get into these pullbacks here, had a small win or a loss, got in here, and it went up to our trading zones. A little later in the day, the dollar had a lot of weakness from 7 to 8. The Australian was still strong, and the Swiss was also strong. You could have been looking for buys in the Australian dollar. Here's 7 to 8. This currency was at a fib level, and it finally broke above it. You have the previous day's high and previous week's high. This breakout right here around 8 o'clock is a good bet. And you might have lost in the first time. It looks like it took off, and then it pulled back, and it would have stopped you out. You buy this next breakout right here, and it came up to the what is this, 10-day moving average right here, and ran out of steam. I would have exited half the trade there, waited to see what it does on the second half, and then it took off. And if you got stopped out in the second half, when it comes up here and breaks out again, we know that the dollar's extremely weak at the time, and the Australian was consistently strong all day against other currencies. You have to buy that breakout there, and you're looking at this as a potential resistance area. The fib level is very likely, and there's lots of different selling areas up here. So when it runs out of steam, you're out of the trade. But you're in this trade around 50, out somewhere around the whole number here. You made 50 pips on that trade. So whether you only made 10 or 15 on the first one, but you made 50 on the second one. Another one you could have traded the very weak dollar against is by selling the weak dollar versus the strong Swiss. The weekly trend of the Swiss started getting really strong again, dark green at 5. So after 5 o'clock, especially 7 o'clock, when the dollar is starting to show some weakness, you want to sell the dollar Swiss. Here's 7 o'clock right here. The market's kind of going sideways. It acted as our fib level that I draw on the charts each week, acted as support. Once it broke underneath there, and it retested it here, aggressive traders might have gone short right here when the IntelliTrend shifted red, about an hour before the eventual explosion to the downside. Or if you want to wait for the low to get broken, by all means get in. You had this fib target, lots of trading potential lows down here. I probably would have got out of most of my trade here around 30. that trade is good for about 50 pips. And anytime you have plus 80 or plus 20 extreme weakness like this, it usually continues, and once a support area like a fib projection target gets broken or a fib level gets broken, it tends to be resistance, and this is. So this makes another great trade. You want to draw your fibs. Anytime a currency is underneath the lower containment band, don't get greedy. When it hits the first fib level, if it stalls, get out of the whole thing. If it slightly goes underneath it, any sign of strength, get the heck out of the whole trade. So you would have probably been out somewhere around 82. This trade here, you're short around 30. That's another 50 pip move. Using the currency meter really takes the guesswork out of trading, because you're in the ones most likely to move, and they don't always continue their trends when you see strength and weakness, but most of the time they do. You had a pretty weak pound starting at 5, and you could have also traded this against the Australian. You sell the weak pound versus a strong Australian. Most of us don't trade this pair, but the pound Australian is likely to go down. Let's bring it up here. Here's 5 o'clock when it became super weak. You might have sold this low here, and whether you got out of this trade with 25 pips, when it started going sideways, you have to sell the breakdown right here, and you can see it fell another 75 pips hours later. So hours ahead of time, you knew to look at the weak pound, strong Australian, and it took it a few hours before it really fell off a cliff, but it did fall off a cliff. Now the Swiss also very strong. You could have also sold the weak pound versus strong Swiss. Let's type that in here, GBP CHF, and guess what? Again, where did it go? The weak pound, very strong Swiss, it went down. And again, at 5 o'clock right here, you had a trend explosion system. You wait for a little counter trend move. You might have gotten short here and lost money. You go short again right here, and it fell from 52.75 all the way down to 51.50. 125 pip move. Now you might not have gotten or stayed in it the whole time down. You can see the weekly trend's very weak, the monthly trend's up. When it hits our trading zone here in a weekly S1 pivot, you might have got out of that trade. It wasn't that weak. It wasn't as weak as it was before. But even if you got out of that trade, maybe you lost 10, 15 pips, you got short again here at 70, you're out of your trade here at 10, you made 60. So you lose 10, make 60. That's a 50 pip net, even if you miss this remaining 50 pip drop, which many people, because the pound was extremely weak and the Swiss was consistently strong on this little pullback right here when it went sideways for 15 minutes, you get short and you draw your fibs again off the last wave, and most of the time that's a great profit target. When it hits that level and it kind of stalls and it stops going down, you get out. So you might have been out of this trade around 60 something. Short around 20, out at let's say 65 for a 55 pip profit. Using the currency meter, it really helps you. Now this isn't the case every day or all the time, but the majority of the time. And you're going to have losing trades when it doesn't work, but they're always going to be small. You have to have if you don't have the patience and discipline to exit a trade when it doesn't work and your stop gets hit, or you get out of winning trades that take off, once it shoots up 10, 15 pips, you're out, and you don't ever get the 50 pip wins, so you're going to have a lot harder time making money. In fact, most people that have small wins and don't obey the discipline of exiting losing trades when they're wrong, they need to be right. The need to be right kills more traders' accounts than anything else. It's not about being right. It's about making money. And on days where you're only right 30% of the time, but you catch one nice 50 or 60 pip move, you can still make money being wrong 70% of the time. So winning percentage is total bullshit. If you focus on that, you'll probably not be a successful trader. It's not about being right. You're going to have days where you're 80% right. You might have days where you're 80% wrong, but you lose very little on those days because you're bound to catch one or two nice trades using our tools.